Gold clinches fresh records, pushing closer to a landmark $4,000 an ounce as the U.S. government shutdown and a political crisis in France inject fresh uncertainty into financial markets. Live from Singapore, this is Insight with Haslinda Amin, where we dive deeper into the stories that matter with crucial context and sharp analysis. Along with gold, the equities rallies also rolling on as AMD's deal with OpenAI adds fuel to the AI frenzy in the markets. We'll speak to top commodities analysts from Standard Chartered and BMI about whether investors need to look beyond the yellow metal. Also ahead, as India's IPO boom brings foreign investors rushing back, we speak to the chairman of the International Financial Services Centres Authority, as well as the MD and CEO of Asia's oldest bourse, the Bombay Stock Exchange. Let's get straight to our top story. Rising political risks in the U.S. and France are sending investors toward alternative assets, with gold reaping the rewards. President Trump says talks to end the U.S. government shutdown are making progress. That's despite the Senate rejecting for a fifth time a House-passed stopgap bill to keep the government open through November 21st. And in France, President Emmanuel Macron has given outgoing Prime Minister Sébastien Lecornu with a rival 48 hours to negotiate with rival parties in a last-ditch effort to stem the country's political crisis. For more on these stories, let's bring in Bloomberg Managing Editor Jill Deeses. Let's start with the U.S. There's so many problems around the world. It does seem like Trump is suggesting perhaps healthcare subsidies could be one way to resolve the situation in the U.S.
Yes, I think, House, at this point, we're still, though, very squarely in the problem of, who's winning the narrative here, right? Because I'll point out that this is ultimately what led the Democrats to not vote for the stopgap spending bill in the first place. So they're really, really tied up on this idea of extending the Affordable Care Act subsidies for ACA premiums through the end of the year, because the big concern that Democrats, led by Chuck Schumer, have really had is if we let those subsidies expire, then everybody's premiums go up. And so that's one thing that ultimately drove them to not vote for the stopgap spending bill. What you do have is now Trump saying that that's something that can be under consideration here, but he ultimately then added on top of that he still wants them to vote for the stopgap spending measure before actually talking about anything involving healthcare, including some other concerns that the Democrats have. Now, of course, if you're a Democrat, Ms. Linda, I don't know how much you trust the Republicans to say, okay, let's pass the stopgap spending bill here, and then let's reopen the government and let's ultimately have those discussions. I think that's really still one of those key trust issues. So maybe they're able to pursue something here. I think we also got some additional comments from Democrats saying, yes, this is the discussion that we want to have, but whether that ultimately leads to a short-term funding plan in order to actually pursue those negotiations or not, I think still is very much an open question.
An open question and a big question mark on whether there is indeed a lot of pressure for both parties to actually sort this out. And some are already saying, you know what, it's going to get to 36 days. Or was it the record 35, thereabouts?
Yeah, I mean, I think ultimately, we still remain at this impasse. It does seem like there's going to be some of those negotiations. I also do think that from the Republican perspective, if you're still trying to look to persuade at least some of those Democrats to come over and vote for a stopgap spending bill, that's still potentially an opportunity here. When all of this first started happening last week, ultimately they only really needed, I think, 8 Democrats to sort of switch sides and then to pass that legislation. So that's still a pressure point that you have. You also have all of these other pressure points that the Republicans are pursuing, including trying to halt funding for various projects. So a lot still happening here, but we'll see whether that ultimately leads to.
And a lot happening in France as well. And now Lecornu has 48 hours to sort things out. I mean, I can't imagine they can come to any kind of conclusion or resolution.
No, I mean, Haas, I think that when it comes to France, this has really just been a catastrophic result for Macron here, right? I mean, losing your third PM, not that Lecornu was ultimately going to likely pass a no confidence vote anyway. I think if you're Macron, you really only have 3 options here, all of which are terrible. You can either try to appoint a new prime minister, that obviously hasn't worked out well, but that's one option. You could try to hold another snap election, try to hold another election here where ultimately his party would probably lose even more power. You have the right wing that would probably assume even more power, or Macron could ultimately resign, which he signaled that he doesn't want to do. But ultimately, really, really tough situation in France right now.
A lot at stake, including the budget as well. Jill, always good to have you with us, especially in the same space. Thank you. Bloomberg Managing Editor Jill Dees there. Now, one asset that's getting a big lift from all the global political disruption is gold. The precious metal is up more than 50% this year and is closing in on the milestone $4,000 level. That's setting off alarm bells for the likes of Citadel's Ken Griffin.
As you see sovereigns around the world, as you see central banks around the world, as you see individual investors around the world go, you know what? I now view gold as a safe harbor asset in a way that the dollar used to be viewed. That's what's really concerning to me.
Let's get more on the gold rush with Standard Chartered's Global Commodities Research Head, Suki Cooper. Also with us, Sabrin Chowdhury, Head of Commodities Analysis at BMI. Suki, let's start with you. It does seem like this is a debasement trade, isn't it? I mean, all the concerns around the U.S. shutdown and also the rising debt around the world.
It's interesting looking at where this rally started. Initially, yes, it was central bank flows. It was a lot of demand from China that was helping to propel prices higher. But that baton has now been passed on to the investor space. And we're seeing ETFs now climbing at an accelerated pace that we haven't seen since 2020. And those ETFs, it's not just the longer term buyers that we've seen in the past. We're now seeing an increasing number of family offices coming into the space. And all of that has been increased by appetites because we've seen concerns around Fed independence, or whether tariff legality, or whether it's concerns about US debt growing, or even concerns about further monetary easing. All of these have helped to propel a lot of interest in gold and has certainly helped to boost that safe haven appetite.
Sabrin, your thoughts on the rally we've seen so far? Less of speculative trades, more to do with structural changes long term?
So gold thrives on uncertainty. Gold is a safe haven asset. It has always been. So the rally kind of started in October 2023. So this is already pretty much a long-standing, long-term rally that we've seen here for almost 2 years now. So most of the drivers of the gold rally so far has been geopolitical uncertainty. So the Russia-Ukraine ceasefire talks, they remain pretty much elusive. The Hamas deal with Israel is going on. There's a lot of uncertainty around there. There's also a lot of uncertainty between Israel and Iran. Although we do have a ceasefire, it's fragile. So U.S. policy uncertainty is also adding to the fuel. So there is a lot of geopolitical uncertainty that is boosting gold. But at the same time, the U.S. Fed rate cut that the entire market expects at this rate in October is certainly driving prices higher, as gold is a non-yielding asset as well.
Well, some are saying that the moves we're seeing so far are akin to the days of QE, are akin to, when we saw those, concerns. Do you see similarities, or is it different this time around?
So
Suki?
Suki.
There are some similarities, and that we're seeing much broader appetite moving into the gold space. Yes, there are concerns around central banks are now adding to their gold reserves and how much that could help to alleviate some of those debt pressures. When gold tends to outperform, it's when we see more a systematic risk really helping to boost that appetite. So there are some similarities, but the big shift this time has come from the physical market. We have seen that central bank buying exceeding 1,000 tons over the past couple of years. And yes, it has slowed down this year, but it still remains very strong. So it's helped to really lift the base for the gold market higher. And further, yes, we've seen some weakening on the jewelry side, but on the broader, in terms of broader investor outlook, it's far reaching now in comparison to where it was back in 2012, 2013.
Sabrin, let's talk about the central bank buying. We're talking about China, India, even the likes of Singapore and Germany. How are you looking at it? Is it a strategic move? Is it a way to diversify away more from the USD?
Yes, certainly. It is definitely a way to diversify away from the USD. Now, let's talk a little bit about the USD. It has been stuck, if you're talking about the DXY index, it's been stuck between 95 to 100 over the last whole year. And it's certainly weakened compared to last year or the year before. And with increasing policy uncertainty in the US, central banks around the world are losing their confidence towards the US dollar. The confidence levels are definitely lower than they used to be. So gold is certainly a more attractive asset to hold with regards to the price rallies we've seen over the last 2 years. Gold is certainly a more attractive asset to hold in light of all the uncertainties and the rigidity of the US dollar.
The thing is, Suki, something is not squaring off here, right? When you take a look at what's been happening historically, we've had an inverse relation between gold and the dollar, but right now we're seeing quite a resilient currency. How do you square that?
It's been quite fascinating seeing some of these longer-term relationships starting to break down. Until the early part of this year, the long-term relationship between real yields and gold had really started to weaken. In fact, the relationship between gold and the dollar has fluctuated somewhat as well. The periods when we tend to see both the dollar and gold rising is in the periods where we have extreme safe haven demand. And we have seen that happening during the global financial crisis, potentially during COVID, we saw bouts of this as well, and most recently. But now we're starting to see that relationship picking up again. So there is some safe haven appetite benefiting both the dollar and gold, but gold seems to be more far-reaching at the moment. But what is key, and we picked this up back in July, is that some of these macro relationships are becoming more important. So as that baton is being passed back to gold in terms of investor space, its currency features are becoming much more prominent here. So that's why we think the market is shifting more so towards some of the uncertainty across the US, while that geopolitical risk is still helping to buoy some of that broader appetite.
Do you think, to an extent, the movements in the dollar might put a lid on how much gold can rise from here?
In terms of some of the allocations, there's concerns that you might see pivots from whether it's central banks or whether it's portfolios away from US-denominated assets and into gold. But also there's just more liquidity in the market as well, and that's benefiting the gold market as well. So, yes, there are continued concerns around where that safe haven positioning could take place, and gold is certainly continuing to be a beneficiary. But in the current environment, it continues to be a number of factors, and the desire to appeal to a much broader market that is still boosting gold appetite.
So, Sabrin, let's look into the crystal ball. Where to for gold in 6 months, in 12 months?
So most of the upside for gold is likely to already been priced in. So we do not expect a significant further rally in the coming months. So possibly the highest that we're expecting at this point, the strong technical, the band, upward band is probably around $4,300 an ounce. We do expect some weakening in 2026 for gold, and this is because of a lot of the uncertainties boosting gold that will clear somewhat in 2026.
And Sabrin, of course, when you talk about gold, you have to take a look at silver. It is actually outperforming gold, up more than 60% year to date. I mean, how much more upside for silver versus gold?
Silver should do well. We do expect continued upside. It's also because silver is used in industrial purposes. So in industry, you need to use silver in different kinds of industry, autos industry, also the renewable energy industry, all sorts of consumer industry. So in that respect, silver should outperform gold. And also because we are seeing some supply issues for silver in the likes of Latin America, etc. So with all these different aspects combining together, we do expect silver to display continued outperformance in 2026 as well.
Some are saying that when you take a look at the movements in silver, which is playing catch up in a huge way, that you're actually seeing a second phase for the commodity space. Do you agree with that?
Yeah, I guess so. I mean, since the start of October 2023, we've seen precious metals overall outperform every single commodity sub-asset class. Gold is the outperformer this year. The Bloomberg Commodities Precious Metals Index has outperformed every single asset class. So it is likely that investors continue to have a positive sentiment towards precious metals.
And Suki, given what we're seeing so far, how best to play gold and the commodity space right now in the next 12 months?
Across the space, we have seen much more upside risk in platinum relative to the gold market, and silver has, of course, started to outperform as well. There's some caution around the silver upward momentum simply because we do know that over the last few years, we've seen the market being heavily undersupplied, but there are sufficient above ground stocks. Now we're seeing some regional tightness that's really seen some dislocation in terms of where that stock is available. So in the near term, we think that the silver market is potentially a little bit more vulnerable because a lot of this movement has been driven by silver ETF flows, and there's now concerns around thrifting and potentially substitution on the industrial side. But we do continue to see further upside risk for the silver market as well, barring short-term corrections. The platinum market, in comparison, continues to look like one that will be undersupplied even going into next year. Gold, on the other hand, we think, other than short-term corrections, in the near term, given that on a technical basis is looking like it is oversold, we still continue to expect prices to average on a quarterly basis $4,000 per ounce going into 2026. So there is more upside risk, given that there's a broad factors that are continuing to buoy this rally. But we think that we could start to see a slowdown in some of that momentum.
Silver to gold ratio still elevated. Is there any key takeaway from that?
For the gold-silver markets, it's certainly a ratio that the market likes to look at. And over the long run, going back 30, 40 years, that average is around about 65. Of course, at the moment, we're trading at much more elevated levels. I think what's interesting here is that when gold first started to rally, it was really that central bank official sector interest that pushed gold higher. And that appetite is absent in the silver market. So the dynamics were quite different. And in fact, silver was tracking copper more closely than it was tracking the gold market. But now that we're starting to see gold's currency features becoming much more relevant, that's where silver is starting to ride on its coattails. So relatively, silver, it looks like it's undervalued compared to gold, but we think that the drivers behind the two of them will continue to be different in that the industrial aspect of silver will continue to be quite dominant. But in the near term, that retail appetite for silver still looks to be strong.
And Sabrin, what's the biggest risk for this gold rally? Some say, you know what, if you get a deal in the Middle East and if you get breakthroughs in trade negotiations, this rally that we're seeing in gold and silver may just end abruptly.
So gold is definitely significantly overbought at the moment, but the biggest risk to gold, the downside risk, is definitely if the U.S. Fed does not cut So the market has priced in a cut in October. A lot of there are a lot of industry companies that are expecting another cut in December as well. So if the U.S. Fed takes a U-turn and starts hiking rates instead of cutting, or even if they just pause in the next couple of months without any rate cuts, then gold is definitely going to see significant downside.
Sabrin and Suki, thank you so much for your time today. Standard Chartered's Global Commodities Research Head, Suki Cooper, and Sabrin Chowdhury, Head of Commodities Analysis at BMI. Now, still ahead on Inside, AMD CEO Lisa Su talks about the partnership with OpenAI and what's next for the two companies. That conversation coming right up. This is Bloomberg. And here's a look at Asian chip makers on the back of AMD's blockbuster deal with OpenAI to develop artificial intelligence infrastructure. Take a look at where we are in terms of TSMC, currently up by almost 3% advantage. And Tokyo Electron also in the positive. We know that Japan is still on lunch break. Tokyo Electron up 0.9% on the back of that AMD signing a massive chip deal with OpenAI. Now, speaking of AMD, its CEO Lisa Su believes that their blockbuster deal with OpenAI is mutually beneficial. OpenAI President Greg Brockman also spoke to Bloomberg about the partnership and shared how his company plans to fund its massive projects.
You can really see that we're very much in we just want compute, as much compute as possible. We think this is important for the economy. We think this is important for the nation. We think this is important for humanity. And so really we're working with everyone in this whole industry in order to get as much compute power online as quickly as we can.
Lisa, I'm sorry, specifics. Where is this data center going to be? Is it one single site? Is it Oracle? That will partner with you on this?
Well, actually, what this really is an announcement of what AMD and OpenAI are going to do together. OpenAI has a lot of partners in terms of where they deploy. I imagine a lot of it will be in cloud service providers. It's really up to OpenAI and Greg and Sam and the team. But the way to think about it is for this amount of compute, it's going to have to be in a lot of different places. I mean, it's a massive amount.
Multiple locations.
Multiple locations. Right. I would imagine multiple providers to really get this online as fast as possible.
Greg, there is a lot of focus on where OpenAI is going to get the money from to fund all of this. Sam Altman's big picture commitment is well documented, right? And the numbers, to his mind, are in the trillions. But have you specifically thought about debt financing for this relationship with AMD? Have you thought about doing a specific equity raise? You are very committed across multiple projects.
Yeah, look, the way that I would look at this is that AI revenue is growing faster than I think almost any product in history, and that ultimately, at the end of the day, the reason this compute power is so important, is so worthwhile for everyone to build, is because the revenue ultimately will be there. Now, as a company that is trying to move as fast as we can, we look at everything, right? We look at equity, debt. We look at trying to find creative ways of financing all of this. That's been actually a huge focus of us for the past couple of years, is thinking about how can we possibly build the amount of compute that is required in order to really transform this whole economy into an AI-powered economy. And so I think you'll see lots of creative ideas, but fundamentally, I think at the end of the day, it is because we believe that
I'm sorry to jump in and interrupt, and Caro, just forgive me on this one. The condition of AMD issuing the stock to OpenAI requires you to spend money, basically, because you have to deliver that gigawatt of capacity first. Lisa, I have to ask you if you have assurances that OpenAI is good for it.
Well, let me be clear. I mean, this deal is a win for AMD, it's a win for OpenAI, and it's a win for our shareholders. And that's kind of the way we put this together. I have full confidence in OpenAI, Sam, Greg, Sarah. I mean, this is a massive opportunity for us. Right now, right here, it's about who has the most compute and how fast can we get it online. And we're committing to doing this together.
Welcome back. You're watching Insight. Jefferies is making a big play in India, moving to enter the country's $900 billion asset management industry. The Wall Street firm has tapped former HDFC asset management chief Milind Bhav to guide its push and secure approvals. Jefferies joins global rivals, the likes of BlackRock, as well as homegrown fintechs in chasing India's booming retail investment market. Meanwhile, India's record-setting month for new listings is taking shape, with LG Electronics India set to start taking orders for its IPO today. That's on the heels of Tata Capital also selling shares for its own IPO, on track to raise $1.75 billion in India's biggest debut this year. For more, Asia Equities reporter Ashutosh Joshi joins us now. Ashutosh, what's driving these listings from the likes of big brands like Tata Capital and LG Electronics India?
Hi, the IPO boom in India is driven by a mix of a strong economic growth, deep domestic liquidity, and investor confidence. We are seeing a strong IPO activity in India this year, followed by record $21 billion of IPOs in 2024. With 3 months to go, expectations are high. More big bang IPOs will be coming to market this year, and 2025 could also be a record year. This week, we are seeing two big IPOs, LG Electronics India and Tata Capital. Both are big brands, and as indicated by strong participation in their anchor share allotments, these IPOs will attract a lot of domestic as well as global interest.
So a bumper year for IPOs, a flurry of IPOs. Are they having any impact on market liquidity in India?
Yeah. To some extent, local equities have seen some liquidity going towards the primary market, that is the new listings. Secondary market in India is undergoing a sort of a lean patch this year. The benchmark Nifty has trailed the Asia's regional indexes, mainly China and Korea, two markets which have done exceedingly well this year. However, despite the underperformance, Indian equities are headed for 10th straight year of positive returns, a feat which hasn't really matched by any of its rivals. And we are witnessing that even though foreign investors have been taking money out of the secondary market, global funds participation in IPOs and new listings remains pretty firm.
Ashutosh, thank you so much for that. Bloomberg's Asia Equities reporter Ashutosh Joshi there. Well, our next guest runs the International Financial Services Center Authority, which is a unified watchdog in charge of the development and regulation of India's financial products, services, and institutions. Chairperson Kalyanaraman Rajaraman joins us now exclusively from the Global FinTech Fest in Mumbai. Mr. Rajaraman, thank you so much for joining us. We've talked about those listings. I mean, IFSCA also looking at its first direct listing, but it's not as big as what we've been talking about. It is about $12 million. Do you expect to see bigger issuances, bigger listings from now on?
Yes, morning, Haslinda. I think thanks for for taking us on this interview. The International Financial Services Center is basically a platform for providing some more additional opportunities and options for both Indian and foreign investors. So while resident businesses will want to raise money in rupee terms, I think to meet the needs of Indian businesses, there are a class of companies which are typically foreign companies who have subsidiaries in India, or Indian companies who have got subsidiaries outside the country which have a requirement for dollar capital. So we see a requirement for such companies to raise dollar equity, through IPOs in GIFT City. So we have the first DRHP which has been filed by one of the companies with our exchange, with the NSE-IX, and we expect that this will be the start of a process. The framework that we have provided is simpler than what obtains in India and more aligned to international regulations, and we'll keep improving that as we go by.
But in terms of bigger listings, is that realistic? Is that what you're looking at? Are you expecting bigger listings?
Yes, so if I may answer the question slightly differently. See, our idea as in setting up the IFSCA is actually to set up a platform which provides options to investors. So if somebody wants to raise dollar capital, I think either debt or equity, I think they would definitely prefer the International Financial Center because there are a lot of cost advantages, there is ease of doing business, and also there is a lot of flexibility. Like for instance, the IFSCA offers full convertibility on the capital account, which means that money can be taken in and out, profits can be repatriated without any approvals required. So taking all this into account, we expect a different class of companies which are probably having a global footprint to step into IFSC to raise money. Already let me say that the top Indian companies and foreign companies are very active in our bond markets. Nearly about $65 billion of bonds have been listed, and that's quite active. If you look at the private equity market also, there are more than 300 funds in GIFT City run by about 187 fund managers, and therefore the equity market in that respect, in form of private equity, private debt, is also very active. The IPO market is the next step forward, and we expect that this will actually scale up once the first issuance happens sometime this month.
You talk about it being an alternative to attract perhaps even global fintech startups. I'm just wondering, what regulatory challenges are you facing in ensuring that goes through without any problems?
So the purpose of setting up this platform is to provide for both Indian and foreign investors a feel and also the convenience and the comfort of operating out of a global financial center. So right from the start, that is 2019, when the Parliament enacted the International Financial Services Centers Authority Act, we put in place about 35 regulations and more than about 16 frameworks in the last 5 years, covering banking, insurance, capital markets, the fund industry, and so on and so forth. And these regulations are completely aligned with the global regulations. I think the idea was to enable them, the investors and the businesses here, to get the same kind of comfort they would obtain in any of the global financial centers. And we are every year we constantly benchmark ourselves by dipping into the wisdom of the market, and constantly we are in touch with global regulators. We are part of the IFSCA and IAIS and other global platforms where we share experience with other regulators and see how we can kind of align more or less completely.
When you take a look at the regulations, I'm just wondering whether there are lessons to be learned from the likes of MES, for instance.
Could you repeat the question?
When it comes to regulations, I'm just wondering whether there are lessons that can be learned from the likes of MES. It has a fintech lab that could be useful in terms of looking at the regulation in India.
Yeah, that's a pretty good question. In fact, let me say that India has been a powerhouse of digital technology. I think some of the large majors in India like TCS, Wipro, Infosys, etc. have been powering the financial ecosystem across the world. So, and also we have a very vibrant startup economy. I think in 2016, the Honorable Prime Minister launched the Startup Action Plan, and we have today nearly about 150,000 startups registered with startupindia.gov.in, out of which nearly about 30,000 are tech startups. And amongst that, I think we have a large majority of fintech startups as well. India's payment services regulation and the revolution that has happened since the Universal Payments Interface was launched several years back, the fintech has actually taken deep roots in India. We expect that fintech to go into sectors such as insurtech, in capital markets technology, in insurance broking, and so on and so forth. In GIFT City, I think the primary focus of digital technologies has been to actually attract a very large Indian diaspora which lives across the world. There are about 15.8 million non-resident Indians who live across the world. There are 19.8 million persons of Indian origin, not to speak of the individual foreigners and family offices, etc. So therefore, we expect that digital technologies currently will be enabling them, providing them the ease of doing business. Like for instance, just about 6 months back, we launched a payment services regulation. Today, more than 6 payment fintechs provide cross-border payment services to non-resident Indians, persons of Indian origin, and a variety of other people, including investors in India, resident Indians who are investing into global markets as well. So this, I think, is the payments has been the first step forward. We already have a few entities which are doing capital markets technology, which are digital platforms for securities market, and so on and so forth. And we will see this expand as we go by.
And Mr. Rajaraman, we also know that Gift City has introduced 0 days to expiry options. I'm just wondering what's behind the idea and how is that going so far?
So typically, I think what IFSCA has attempted to do in the past is to actually be a complement to the domestic ecosystem. So there are many constraints which actually restrict the possibility of certain products and services in domestic India. So we have been actually playing the role of a complementer, which actually keeps the requirements and the interests of foreign investors and investors who are outside the country in our mind. So therefore, this is actually to provide that complementary facility which would interest a lot of institutional and other investors across the world. For example, let me say that in the banking sector, we have a number of products which do not obtain in the domestic market, something like, say, acquisition financing, leverage for hedging and for the hedge funds, things like, say, asset financing for the aviation and shipping sector, and so on and so forth. So similarly, in the capital markets, as well as you rightly mentioned, I think the single day intraday options are something which actually will support a complementarity for foreign investors who are looking at a variety of products that they would like to invest into.
But might it risk greater volatility? Might it risk greater systemic risk as well?
Yeah, so we will be keeping all of that in mind and ensuring that I think we ensure that the investors stay protected as part of this process. So our risk management and surveillance and monitoring systems will work in tandem with domestic regulators as well.
Mr. Rajaraman, I'm just wondering how you're planning, how you're thinking about deepening the liquidity in terms of Gift City exchanges, especially in the areas of derivatives.
So I would say that in case of the National Stock Exchange, NSE-IX, the connectivity with the Singapore Stock Exchange has paid off very well. I think we have a very large number of institutional investors who come in through the SGX platform and trade. Similarly, I think the IFSC has also launched through the NSE-IX remote trading program, which is offered by both the exchanges. While NSE-IX trades the GIFT Nifty 50, the India INX trades the Sensex. So we see that the opportunity here in terms of providing the various kinds of methods of trading, both for brokers who are physically present in Gift City as well as institutional and other investors who wish to trade remotely from other jurisdictions. So by providing all this flexibility, I think we are able to attract and ensure that the product stays liquid at all times. In fact, the GIFT Nifty 50, the average trading volumes have reached about $100 billion on any given day, with open interest which range between $13 to $20 billion at the end of every given day. So I would say that the products are pretty liquid, and we expect that this to scale up as time passes by, and there is more interest into India as a developing economy.
We are tremendously compute constrained. It feels like we're in this kind of recurring theme of being compute constrained, and I think the reason for that is the answer to the question you asked, which is demand.
Right.
We see there are multiples of demand that are latent and untapped from what we have today, and even today, obviously, by any standard, demand and revenue growth has been torrid in its pace. And so really we have to invest ahead of that. And I think that's going to be the rate limiter for us to be able to go capture demand, whether it's consumer or enterprise, and for us to be able to build new models, parallelize more experiences, more product experiences, and then enable users specifically to be able to use those products more actively in their daily life, at work, and at home. And so, even things like Sora, the app we just launched, we wish we could invite more people onto it now, but we just need more compute. So the AMD deal, we're excited about being, directionally a way for us to do that.
I've got to ask about the report that OpenAI closed secondary, or the ability for employees to sell shares at a $500 billion valuation. I already asked you this question, but what is the metric we're supposed to judge your success by? The $500 billion valuation, the 6 billion tokens per minute? To you, Brad, what is it?
For me, it's actually kind of a metric that we talked about is tokens. It's you mentioned 6 billion tokens per minute on our API. That is the purest, for me, the kind of essence of utility is that consumption metric. And so we actively track that metric to see how people's consumption of AI is growing over time. And you see this happen in amazing ways. So things like Codex, for example, we've seen grow 10x since August, purely on consumption of tokens around coding. And you start to see that same pattern emerge across multiple lanes of use and across multiple areas of work. And that's the metric I look at, because if that number is going up, it means people are using us for more things, and that's the ultimate goal.
Right, welcome back. Let's head back to the Global FinTech Fest in Mumbai and bring in the Bombay Stock Exchange MD and CEO Sundararaman. Ramamurthy joining us right now. Sir, good morning from Hong Kong, and thank you for joining us and being patient here. What a time to be speaking with you. What a week, and it's certainly been extremely busy. I guess the basic question I have is, help us understand why we've suddenly, relatively speaking, seen this resurgence in equity markets raising there where you are.
I think I lost your voice in the end. Can you repeat the question?
Oh, I was wondering why we're suddenly. What would you attribute this resurgence in activity, IPO activity specifically, in your part of the world?
This could be ascribed to the following reasons. One is when you look at the IPO activity, it is clearly at a very good high. That shows the type of faith that the market has into the Indian economy's growth. The way in which the Indian government is taking the country forward, the proactive policy reforms that we are seeing in terms of GST reforms and tax reforms which are in the offing, and the regulatory setup and the faith that the people have in that, the growing consumerism in India, which is mainly attributed to the type of GDP growth rate that we are seeing and the demography which we have, and the government's continued investments in the private capital investment coming into the market, all these are in a great way responsible for the resilience that is exhibited by the Indian market, and therefore you are able to see this resurgence in the IPO market in India.
Help us understand, and I want to ask you, by the way, about derivatives and options in a moment, but just to continue the conversation specifically on ECM and IPOs, what does the pipeline look like?
The pipeline actually looks wonderfully well. If you look at it, last year, we did a record IPO. Actually, around 330 companies raised funds to the extent of around 20 billion. Probably we were the largest in terms of the number of corporates which were able to raise capital in the globe, and second largest probably next to US in terms of the value raised. This year, till now, around 150 companies have raised around 5 billion in the last half year, and around $30 billion worth IPOs are in the pipeline. 10 already have been approved and they are waiting for the right time to come to the market. 20 billion worth of IPOs are in the pipeline. I think this year again is going to be a wonderfully great year for the IPOs. The pipeline is strong, the economy looks good, and therefore the IPO resurgence will continue is my view.
And, let's hope that's the case. These are fairly big numbers you just mentioned there, sir. Thank you for clarifying and attaching some figures to that. Can I ask you then about how you're looking to address the sort of product pipeline across the stock exchange itself? Options and derivatives, what specifically do you think will come online before the end of the year or into the first quarter of next year?
It's very tough to predict what the market will be and what BSE will be for the next 1 quarter or 2 quarters or whatever it is, because we generally don't talk of forward-looking numbers. But what I can put across to you is like this: it's just a beginning for BSE. If you look at it, BSE is doing a catch-up growth in terms of the derivatives volume and the cash market volumes. 30 months before, we did not have any derivatives product to talk about. And today, when we introduced the Sensex 30 option, which was a longer-awaited product for the market, you are able to see traction and it is growing. And it's not cannibalizing any volumes. If you look at it on its own, it is growing because it is just filling up a gap. And in equities market as well, we are filling up some gap which is in existence, and therefore our market share is growing. So the simple answer to the question is, well, I will not be able to put any numbers of what will be the growth in the next quarter. Since we are just filling up a gap that is already in existence, I think the future looks good for us in terms of derivatives market, apart from various other markets as well.
Okay, absolutely, and thank you so much for clarifying that. If you just one final question, if we could, maybe we're out of time, just to keep it short. Then, do you have a specific or maybe a rough target in terms of? You mentioned cash and derivatives volumes as a piece of the pie. Where would you like to see that?
So, in terms of volumes, we don't look at where we want to see ourselves. Our motto and goal has always been increasing the market depth and penetration. So what do we mean by that? We want more number of participants, more number of FPIs, more products to be participating in the market. When we started our journey in derivatives, we had no brokers associated with BSE. Today I have 500 plus brokers.
Sundararaman, Ramamurthy there. Thank you so much for the time. Apologies, we're out of time. We'll speak to you soon. Thank you so much.